welcome to this explainer. Okay, let's dive right into something that's probably kept you awake at night at least once or twice: your money. And more specifically, what happens to your hard-earned investments when the markets start getting choppy. Today, our main goal is to completely demystify investment risk. Instead of seeing it as this terrifying, uncontrollable force, we're going to look at the data, break it down, and turn risk into a manageable, structural tool that you can actually use to your advantage. So let's kick things off with a really fundamental question. Can you actually avoid risk when investing? It's a totally natural human instinct to want to protect what's ours, right? And a lot of newer investors assume the ultimate goal is just finding a completely safe, bulletproof place to park their cash. But as we'll see, the concept of safety in the financial markets is highly subjective. In fact, trying to completely eliminate risk might just be the biggest mistake you can make. Well, here is the hard truth. The only way to avoid market risk entirely is to literally stay out of the market altogether. But here's the catch. Playing it entirely safe is actually incredibly costly. If you just stuff your cash under a mattress or leave it sitting in a checking account making zero interest, you are totally missing out on the wealth-building magic of compound interest. And honestly, worse than that, over time, you're mathematically guaranteeing that your money will lose substantial purchasing power. Part 1. The reality of risk. Beyond market crashes. You know, when most people hear the word risk, they immediately picture this dramatic, headline-grabbing stock market crash wiping out their retirement. But the reality is that risk takes on so many different, often completely invisible forms that are working against your portfolio every single day. Let's say you buy a bond with a 5% yield. You might think, great, I'm getting a solid, safe 5% return. But if inflation is running at 3%, the cost of groceries, housing, literally everything else you buy is going up. So your real rate of return, the actual gain in your purchasing power, is only 2%. Rising costs silently shrink the actual value of your money. It makes inflation a massive hidden risk to your wealth. Market risk basically breaks down into two main buckets: systematic and unsystematic risk. Systematic risk is external. It's the big stuff you simply can't control, like interest rate hikes, recessions, or geopolitical shocks. It affects the entire market system. Unsystematic risk, on the other hand, is internal. It's specific to a single company or industry. Think of a CEO scandal or a massive product recall at one specific brand. Knowing the difference here is absolutely crucial because we manage these two types of risks in very different ways. Part 2. Knowing your risk profile. Mind versus math. Understanding the market's risks is really only half the equation. The other half is understanding yourself, your finances, and how you, as a human being, react when the numbers on your screen inevitably turn red. This is the investor's emotional roller coaster. It's a classic concept in behavioral finance that maps out exactly how we feel as markets move. At the top of a bull market, there's thrill and euphoria, right? We all think we're investing geniuses. But when markets dip, that euphoria turns into anxiety, denial, and eventually total panic at the very bottom. This emotional cycle is incredibly dangerous. It so often leads to panic selling, which is a virtually guaranteed way to ruin a portfolio by locking in temporary losses. So the crucial point here is defining your true risk profile, which is actually split into two distinct parts: tolerance and capacity. Risk tolerance is psychological. It's your personal comfort level with uncertainty, basically how well you can sleep at night when your investments are down. But risk capacity, that is purely mathematical. It evaluates your actual financial ability to withstand those losses based on your income, your assets, and your time horizon. You might have the iron stomach of a day trader, but if you're retiring next year, your mathematical capacity for risk is actually quite low. Part 3. The asset allocation compass, finding your balance. Now that we understand the external risks and our own internal triggers, how do we actually build a portfolio to survive all of this? Steve Bryce puts it perfectly. He says, if asset allocation is the compass that can help guide investors, rebalancing is the process of regularly adjusting the magnetized needles. I love that. Think of investing like sailing a ship across an unpredictable ocean. You can't control the weather. That's our systematic risk. But your strategic asset allocation, that serves as your guiding compass to keep you heading firmly towards your ultimate financial goals. When you start tweaking the splits between equities, like your growth stocks, and bonds, it drastically changes your expected return and your risk profile. A 100% equity portfolio has massive growth potential over time, for sure, but it also comes with huge, terrifying drops. By blending those growth-oriented equities with stable bonds, you're directly shaping your potential maximum risk and rewards to exactly match your personal risk capacity. It's all about finding that sweet spot. Part 4. Active Risk Management Tactics. Navigating the Storm. Setting that compass isn't a set-it-and-forget-it kind of deal. We need smart, tactical execution to maintain your portfolio's carefully chosen balance as the markets shift and drift over time. And the most critical tactic here is rebalancing. The historical data on this is just undeniable. When you compare a portfolio that is actively rebalanced every single year against one that's just left totally alone, the annually rebalanced portfolio historically achieves higher absolute returns and significantly higher risk-adjusted returns. Rebalancing literally forces you to systematically sell high on assets that have grown and buy low on assets that have shrunk. It acts as this incredible mechanical discipline that strips human emotion entirely out of the equation. Another absolute game changer is dollar cost averaging, or DCA. This is just the simple practice of investing fixed amounts of money consistently on a set schedule, totally regardless of what the market happens to be doing that day. If you've ever stressed yourself out trying to figure out the perfect moment to buy a stock, DCA is your logical antidote. It completely prevents you from trying to time the market. That means you naturally end up buying more shares when prices are low and fewer when prices are high. Now, what if you're managing specific, individual positions, dealing with that unsystematic risk we talked about? Well, stop-loss orders are essential here. A stop-loss is basically an automatic instruction to sell a security the very moment it drops to a predetermined price. It is hands down one of the simplest and most effective ways to enforce discipline and strictly limit your downside on a trade. By setting these hard boundaries in advance, you prevent a small, manageable loss from spiraling into a devastating portfolio hit. And, when the broader market gets genuinely stormy, that's when we look to safe haven assets. We're talking investments like U.S. Treasuries or gold, assets that generally retain or sometimes even increase their value during periods of high market stress. Strategically holding assets that act inversely to the general panic can provide your portfolio with critical stability and liquidity right when everyone else is scrambling. Part 5. Staying the course, the long-term perspective. Listen, all the sophisticated tactics in the world won't help if you don't have the patience to let them work. Successfully weathering the market is an ongoing habit. Let's quickly review the core, undeniable truths of the financial markets. Number 1, there are absolutely no guarantees in investing. Number 2, past performance does not equal future results. Just because a stock went to the moon last year doesn't mean it will this year. And number 3, risk and potential return are almost always perfectly correlated. If you want high returns, you have to accept high risk. Keeping these principles front of mind is exactly what reinforces your emotional discipline and keeps you focused on the long-term horizon. I really want to leave you with this profound thought from Benjamin Graham, the legendary father of value investing. He said, "The essence of investment management is the management of risks, not the management of returns." That is incredibly powerful. Think about it. You can't control what the stock market will return next year, but you absolutely can control your exposure to risk. Protecting your wealth through smart allocation, diversification, and rigorous discipline is the true secret to steadily growing it over a lifetime. Which brings us to our final, critical question for you to consider today. Is your portfolio built to weather the next storm? The markets will always have unpredictable turbulence, but now that you understand how to read your asset allocation compass, objectively assess your risk capacity, and deploy active management tactics, you don't have to be at the mercy of the waves. Take a look at your own investments this week and make sure your financial ship is heading true north. Thanks for joining me on this explainer, and keep learning.